range, what we consider normal volatility. So, when a candle suddenly breaks above this average range, it's not just noise, it's a signal. That spike tells us volatility has surged, and that is how we identify a high volatility event. This indicator zeroes in on those rare high volatility candles. Bullish spikes are highlighted in dark green, while bearish ones appear in dark red. But it doesn't stop there. The indicator also marks the midpoint by default of each high volatility candle, automatically drawing horizontal levels that act as potential support or resistance zones. Zoom in on those levels and you'll spot something subtle but powerful. Small circles that occasionally appear when price taps into a zone, but doesn't close beyond it. This wick rejection is a key signal. It suggests the level is holding, and it's often the perfect moment to consider a trade. Now, if you open up the indicator's settings, you'll find some interesting customization options, starting with the ability to switch between historical and trailing display modes. In historical mode, which you've seen so far, the indicator draws a separate line from every high volatility candle. Each time price retests one of these levels, it marks the interaction with a dot. This mode gives you a detailed history of how price has respected or rejected past volatility zones. Trailing mode, on the other hand, works differently. When a new high volatility candle of the same type appears, and the previous level hasn't been broken, the line updates to reflect the most recent candle's values. This creates a dynamic, trailing level that adapts in real time while keeping your chart cleaner. We also wanted to give you flexibility in how support and resistance levels are drawn, because different traders prefer different reference points. With the percentage setting, you can define exactly which part of the candle is used. Setting it to 100% will anchor the levels to the candle's close, while 0% uses the open. You can fine-tune anywhere in between, depending on how you interpret candle behavior. Just below that, you'll find filter settings that let you adjust the sensitivity of the volatility detection. This is where you can tweak the ATR multiplier and other parameters to better match the dynamics of your specific market or trading style. And finally, the style options give you control over how the indicator displays, like adjusting the colors of bullish and bearish volatility candles to fit your chart aesthetic. And that covers all the settings available within the indicator. Now, let's shift from theory to practice and see how this tool performs in real market conditions. Now, you can absolutely experiment with this indicator and develop your own strategy. But based on our testing, here's what we've found to be a reliable approach when tracking trades. The first thing we look for is confirmation that the level, created by a high volatility candle, is actually acting as support or resistance. In this example, we have a bullish volatility candle, and what we want to see are at least 3 interactions with that level. In other words, 3 rejection dots. That tells us price is respecting that zone, but we're not jumping in just yet. On that 4th touch, we want more than just a reaction. We want a high volatility candle to either break or bounce off the level. This signals that volume and momentum are backing the move. After that, we wait for price to return and interact with the newly established resistance, rejecting it in the same direction as the breakout. That's our trigger. From there, we place our stop just above one of the volatile candles and target a clean 1 to 2 risk to reward setup. In some setups, these high volatility candles can serve as direct entry triggers for your trades. You can use the accompanying support or resistance line as your stop loss level, and another volatility zone as your target. In this example, we've set the support and resistance levels to 0%, so they're drawn from the open of the candle, giving us a precise baseline. We're also using the NeoCloud from the Signals and Overlays toolkit to confirm our directional bias. When it's blue, we're only looking for long setups. When it turns red, we're hunting for shorts. In this case, the cloud is red, so we're focusing on short opportunities. What we want to see is a volatility spike, a candle that aggressively rejects the NeoCloud resistance. That's our entry. From there, we place our stop above the resistance line drawn by the volatile candle, and we set our target at a lower support zone formed by another high volatility event. And that wraps up our breakdown of the candle body support and resistance indicator, an intuitive way to pinpoint explosive price moments and uncover hidden support and resistance zones with precision. You can start using it right now, completely free, at luxalgo.com/library. And if you want to take your trading confidence to the next level, don't forget about the Signals and Overlays toolkit we used alongside it. Tools like the NeoCloud give you that extra layer of directional clarity, helping you filter noise and lock in on high probability setups. You can try it out risk-free for 30 days at luxalgo.com. Thanks for tuning in. Trade with intention, manage your risk, and we'll see you in the next one. You're about to miss the most powerful breakout of the month, and you won't even see it coming. Why? Because it's hidden inside the one thing traders overlook the most: ranges. But what if you could flip that weakness into your secret weapon? In this video, we're going to show you a tool that does just that. And it doesn't just reveal consolidation zones. It maps them out for you in real time. Flags break out the moment they happen, giving you a serious edge, while others are still guessing. Let's get into it. Everyone talks about markets going up or down, but what often gets overlooked is how long they're doing either. When that movement stalls, when price doesn't push far in either direction, that's when consolidation develops. But these ranges aren't just dead zones, they're pressure cookers. Volume builds up, liquidity concentrates, and when that tension finally breaks, it's often with explosive force. And if that explosive breakout doesn't come immediately, price tends to revisit them, where they'll act as hotspots for taking profits, stop losses, and major trading decisions. Knowing this is exactly why we built the range detector. It automatically scans your chart, locks onto these high-value zones, and alerts you the moment a breakout begins. So you're not reacting late, you're prepared early. Once you apply the indicator to your chart, you'll immediately notice colored boxes. These are the detected ranges. Each range actually begins in the color blue. You'll also see a vertical line. This marks the exact candle where the range was detected, giving you a precise visual cue. From there, the high and low of the range are then projected forward, forming a boundary. When price breaks through, the range will shift colors between green for bullish breakouts and red for bearish ones. It is also worth noting that if price reverses after a breakout, but no new range has yet formed, the box will flip color to match the latest breakout direction. That means the final color you see on any past range always represents the last confirmed breakout before a new zone is detected. Inside the settings of the range detector, you'll find 3 core options that directly influence how ranges are identified on your chart. The first is minimum range length, which determines how many consecutive candles must remain within a tight, volatility-based envelope before a range is confirmed. Choosing a lower value, like 10 to 15, allows the indicator to detect quicker, shorter consolidations. Useful if you're aiming for more frequent signals. On the other hand, setting it higher, say between 30 to 50, focuses detection on longer, more significant pauses in price action, often leading to fewer but more powerful breakout opportunities. The second setting, range width, adjusts how wide the ranges appear, using volatility measured via ATR. Smaller values will tighten the range zones, capturing more compact consolidations, while larger values expand them to encompass broader market movements. Lastly, ATR length controls how volatility itself is measured. A shorter ATR period will make the tool more responsive to price shifts, while a longer period smooths the output, helping to filter out noise and highlight only the most stable, consistent volatility environments. Below that are just some styling options to give users more control over how the ranges and breakouts appear on the chart. And now that you have a strong understanding of how this indicator works, here are some examples of how you can use it in your trading to actually get the most out of your setups. In this setup, we can see that a range has been successfully detected. Now, rather than trading within the consolidation, which, as every seasoned trader knows, is often a recipe for getting chopped up, we wait for a decisive breakout to signal directional intent. In this case, price breaks down below the range, confirming a bearish move. What's crucial to understand here is that the range itself now represents a high-volume zone, a region where many traders likely got trapped. This makes it a prime area for liquidity grabs on any pullback. However, simply entering on a retest isn't enough. To increase precision, we want to align this pullback with a clear imbalance in price. To do that, we'll turn to the Price Action Concepts toolkit and enable the Fair Value Gap Imbalance setting. Then set that to a higher time frame, such as the 4-hour. In this example, we spot an imbalance sitting right at the low of the breakout, an ideal alignment. But note that even if that imbalance were slightly higher, it could still be valid. What's important for a bearish setup is that the imbalance doesn't sit above the midpoint of the range. For bullish setups, you'd want the opposite. The imbalance should not fall below the midpoint. From here, we simply wait for price to retest and reject this imbalance, as it does in this case. That's our entry trigger. Stops go just above the imbalance, and we aim for a clean 1-to-3 risk-to-reward ratio. Now, as mentioned earlier, once a breakout occurs, the detected range high and low continue to plot on the chart until a new range forms. This persistent visual reference makes these zones valuable for setting both take profit and stop loss levels. In this example, we see a bullish breakout. Now price often breaks out, then retests the range's high or midpoint before continuing its move, which is similar to what we did in the first example with the imbalance confluence. But this time you have confirmation, and we also see a clear uptrend structure forming, which gives us added confluence. Now, instead of relying on a fixed risk-to-reward ratio, we can identify our target more dynamically. One smart method is to look for the most recent consolidation zone above the current price. Since it previously acted as a range, there's a strong likelihood it will serve as resistance or another pause point again. That makes it an ideal level to aim for your take profit. Now, that's just a glimpse of how the range detector can level up your market analysis. We hope this walkthrough gave you a solid understanding of how it works and how to integrate it into your own strategy. You can start using the range detector right now, completely free, at Lux/library. And if you want to take things further, the price action concepts toolkit we used in this video is also available for you to explore, risk-free for 30 days at luxalgo.com. Thanks for tuning in. Until next time, trade smart, and we'll see you in the next one.
Build a website you love with Wix. For your words, create your brand, your opportunity, your breakthrough. Feeling a vibe? Run with it. From can't look away to gotta have it. Make every detail yours. Bring out what's hot. Remove what's not. Crystallize it. Instantly set a tone that speaks in your voice to your audience. Keep moving. Your site grows with you. Add solutions that meet you where you are and take you where you want to go. Smooth to make, easy to love.
You've been analyzing structure wrong, and it's not your fault. For a while now, we've been deep in the trenches, testing every structure theory we could find, and what we discovered turned everything upside down. We've built something different, and today we're revealing a new indicator with a new approach, one that doesn't require a length input from the user, and it maps not one, not two, but 3 layers of structure, significantly minimizing lag and making it ideal for capturing the most subtle shifts between bull and bear markets before anyone sees it coming. If you've ever felt like you were always one step behind when analyzing market structure, strap in as we demo this new indicator. Most market structure tools force traders to decide upfront how deep or shallow their pivot detection should be. Too shallow, and the chart explodes into noise. Every minor jiggle crowns itself a swing. Too deep, and the important shifts vanish until they are ancient history. This indicator sidesteps that dilemma by adopting an alternative method of detecting structure, where market structure is shaped by 3 distinct levels of swing points: short-term, intermediate, and long-term. This cascading logic means the indicator is constantly self-tuning, without ever requiring a pivot length input or any form of guidance from the user. And since this indicator relies solely on closed bars, yesterday's candle can never be revoked. What you see in the moment is what remains on the chart forever. Nothing repaints. Once added to your chart, you'll immediately see 3 distinct types of lines, each representing a different layer of market structure. The dotted line captures short-term structure. It's your earliest signal, ideal for spotting a trend continuation or potential reversal, before most indicators even flinch. Then comes the dashed line, marking an intermediate level shift. This serves as a more reliable confirmation, useful when you want to filter out noise and catch cleaner setups. Finally, the solid line represents long-term structure changes. It's the most significant signal, and by default, it's the only one labeled LTMSS, long-term market structure shift. At the swing points that define this structural change, you'll also notice subtle dot markers. These visually confirm the precise pivots behind each long-term shift. But here's where it gets powerful. Every layer is customizable. Jump into the settings and you'll find dedicated sections for short, intermediate, and long-term structures. Want labels for the other levels? You can turn them on. Prefer a different line style or color scheme? It's all adjustable. You can even choose to display a floating label for structure type, instead of just decoding by line style alone. In short, you're not just seeing structure, you're tailoring how it's shown, so it aligns perfectly with how you trade. And unlike most structure indicators that rely on static pivot counts, each layer in of structure in this indicator adapts dynamically, making it uniquely effective in chaotic or fast-moving markets. It doesn't wait for a fixed number of bars to confirm a swing. Instead, it reads the intent of price itself, allowing you to detect structure where other tools may get lost. In this example, we're using the Signals and Overlays toolkit to algorithmically determine directional bias, with the ML classifier enabled to rate each signal from 1 to 4, where 1s and 2s indicate a retracement, and 3s and 4s confirm trend continuation. In this case, a level 2 confirmation tells us the market is pulling back within an uptrend. As the candle colors shift from purple to red, we see momentum building, marking the transition from a weak trend to a strong one. But the real insight comes when we enable the pure price action structure overlay. All three layers of structure appear during the retracement, even before the candles transition to red for strong bearish confirmation. This gives us a roadmap. A short-term confirmation during the red candles could serve as the initial entry and our smallest position. Then, as the trend strengthens and structure shifts align with the directional bias, intermediate confirmation follows, offering a more solid entry. And finally, when the long-term structure breaks, it provides the strongest confirmation for scaling in further. And there, you have three positions entered, all at different levels of confirmation. It's important to note that entries at the long-term level can sometimes face short retracements before continuation, which makes this layered, confirmation-based approach especially effective for managing risk while positioning with the broader trend. In this next example, we're focused on confirming a strong long-term trend. However, as mentioned earlier, significant long-term confirmations are often followed by deep retracements before the broader move resumes. So how do we handle entries following those market structure changes? Here, we've identified a long-term break of structure confirming bullish intent, and after some upside movement, we start to get a pullback. Instead of guessing where to enter, we can improve timing by identifying oversold conditions within the retracement using a tool like the RSI. Once price enters an oversold region while long-term structure remains intact, we begin looking for short-term structure confirmations. In this case, as price exits the oversold zone, we receive that short-term signal, prompting a small, early position. Because it's a lower-tier confirmation, we size conservatively and aim for nearby highs. What's crucial here is how that short-term confirmation offered an early opportunity to enter, rather than waiting for the intermediate confirmation, which, in this instance, arrived too late. It's a clear demonstration of why short-term signals shouldn't be overlooked. They can provide precision entries and improve risk-reward when used within the broader structural context. And that's just a glimpse of how this multi-layered structure tool can transform the way you read price action by giving you real-time clarity across short, intermediate, and long-term trends. We hope this walkthrough helped you understand how to use it effectively and how to adapt it to your own trading strategy. You can start using this tool completely free at luxalgo.com/library. And if you're looking to enhance your edge even further, the Signals and Overlays toolkit we featured in this video is also available to try, risk-free for 30 days at luxalgo.com. Thanks for watching, trade smart, and we'll see you in the next one.
You spend a third of your life sleeping, so why not sleep comfortably? Right now, during President's Day sale, you can save up to $1,000 on select Beautyrest mattresses and free delivery, exclusive furniture where low prices live.
How many times have you seen this structure? The market creates a low and then a high, and you're advised to wait for a pullback to enter. But let's be honest, we've all entered trades at what seemed like the perfect entry price, only to watch the market stop us out. Today, we're providing a solution for traders looking to perfectly time their entries between these ranges. This indicator doesn't just detect ranges, it clearly plots entry points, take profit, and stop loss levels for you, all in real time. And the best part, we're giving it away completely free. So, if you want access to this indicator, stick around. We'll show you exactly how it works and how you can get your hands on it. Let's dive in. First, let's clarify what defines a range, as traders often confuse ranges with consolidation. A range is defined by two significant swing points, a high and a low. As long as the price stays between these points without breaking either, the market remains within that range. Consolidation, however, typically occurs after forming higher lows or lower highs within the range, indicating that the market is struggling to break out and losing momentum. This indicator specifically targets ranges, not consolidation patterns. When using the indicator, you'll notice clear red and green lines on your chart. These lines indicate the high, low, and midpoint of the detected range.